Most traders believe they are losing because their strategy is wrong. But that is rarely the real problem. The truth is much simpler and much more uncomfortable. Your timing is wrong, not slightly wrong, completely wrong. You are entering when patience is required and exiting when conviction is required. And that single mistake quietly drains your account. Most traders spend years searching for the perfect strategy. They change indicators, they change time frames, they change markets. But the strange thing is this: even when they find a strategy that works, they still lose money. Why? Because timing is not just about entry signals. Timing is psychological. The majority of traders enter a trade the moment they feel opportunity. But feeling opportunity is not the same as having one. Markets move in waves of patience and impatience. When a market begins to move, inexperienced traders feel an urgency to participate immediately. They believe they must act before the move is gone. It rewards patience. The professional trader understands something the majority ignore. Most moves develop slowly before they become obvious. The early stage of a move is rarely the best entry, yet that is exactly where the majority enter. They anticipate the breakout before it is confirmed. They buy before momentum exists. They short before weakness appears. And when the move hesitates or retraces, which markets almost always do, they panic. This is where the first major timing mistake appears: entering before confirmation. The amateur trader believes anticipation is skill. The professional trader knows anticipation is risk. Markets rarely move in straight lines. They test conviction. They create false signals. They trap impatient traders before beginning the real move. And that trap is built on poor timing. If you enter too early, even a correct idea can become a losing trade. Imagine buying a stock because you believe it will rise. You are right about the direction, but you enter before momentum confirms. Price pulls back. Your stop gets hit. Minutes later, the real move begins. You were correct about direction, but wrong about timing. And in trading, timing often matters more than direction. That is a difficult truth for most traders to accept, because it means the problem is not the market. The problem is discipline. Professionals wait for confirmation not because they enjoy waiting, but because confirmation reduces uncertainty. The majority enter because they fear missing the move. The minority enter because the move is proven. That difference defines profitability. Timing is patience under pressure, and patience is extremely rare in financial markets. The second timing mistake is emotional entry. Most traders believe their decisions are logical, but the market exposes emotions quickly. Fear of missing out is one of the most expensive emotions in trading. You watch a chart begin to move, the candles grow larger, momentum builds, and suddenly you feel the pressure to enter. You tell yourself you are following the trend, but in reality, you are chasing it. By the time the majority feels confident enough to enter a trade, the move is often near exhaustion. Markets tend to move in cycles. Early participants create momentum. Late participants provide liquidity. The late participants are usually retail traders chasing movement. This creates a painful pattern. Traders buy after the move, then the market pauses, momentum slows. A pullback begins. Now the same traders who entered confidently feel trapped. They exit during the pullback, and once they exit, the market often resumes its trend. Again, the issue was not direction. It was timing. Entering late is just as damaging as entering early. The professional trader studies timing through structure. He observes where liquidity sits. He understands where other traders are likely to panic. He waits for the market to show its hand. Instead of reacting to movement, he reacts to confirmation. This approach requires emotional neutrality. You must be comfortable watching a move develop without participating. That is extremely difficult. Human psychology prefers action. Doing nothing feels like missing opportunity. But in trading, doing nothing is often the most profitable decision. The best traders spend far more time waiting than trading. They are selective. They wait for high probability conditions. They wait for market structure. They wait for momentum confirmation. And when those elements align, their timing becomes precise. Precision comes from discipline, and discipline separates professionals from amateurs. Another critical timing error appears during exits. Most traders focus only on entry timing, but exit timing is just as important, and here the psychology becomes even more revealing. When a trade begins moving in your favor, something interesting happens. Fear appears again. But this time, it is the fear of losing profit. So traders exit early. They take small profits quickly. They feel relief. But relief is not profitability. The professional trader understands that markets pay traders who allow their winners to develop. Small profits cannot compensate for repeated losses. Yet the majority reverse this equation. They allow losses to grow and cut profits short. Why? Because emotional timing replaces strategic timing. The correct timing for exits is determined by structure and probability, not by emotional comfort. Professionals exit trades when their reason for entering disappears. Amateurs exit trades when they feel nervous. That difference compounds over time. If your average loss is larger than your average win, your timing is broken, not your strategy. Timing is the invisible factor in profitability. Two traders can use the same strategy and produce completely different results. One trader enters too early, the other waits for confirmation. One trader chases momentum, the other enters during controlled pullbacks. One trader exits winners too quickly, the other allows trades to develop. Same system, different timing, different outcome. This is why experienced traders focus heavily on execution. Execution is timing in action. Without precise execution, even strong strategies fail. The market does not reward ideas. The final piece of timing is psychological stability. Because timing is not just about charts, it is about controlling impulses. The market constantly creates emotional pressure. Rapid movement triggers excitement. Sudden losses trigger panic. Unexpected volatility creates confusion. And under these conditions, most traders abandon their timing rules without even realizing it. They start reacting instead of executing. They enter trades impulsively. They exit trades prematurely. They chase recovery after losses. They double down after wins. And slowly, without noticing, their discipline disappears. Professional traders understand that timing must remain consistent, regardless of emotional conditions. If the market is volatile, their rules remain the same. If they experience a losing streak, their rules remain the same. If they experience a winning streak, their rules remain the same. Consistency stabilizes timing, and stable timing creates reliable execution. The truth is simple. Most traders are not losing because they cannot analyze charts. They are losing because they cannot control the moment they act. They act too early. They act too late. They exit too quickly. Or they hold too long. The market rewards the trader who can act at the correct moment and remain inactive at every other moment. And remaining inactive is where most traders fail. Doing nothing feels uncomfortable. When you sit in front of a chart and see price moving, the instinct is to participate. The mind begins to create stories about opportunity. This might be the move. I should get in before it's too late. I don't want to miss this. But the professional trader understands something critical. Opportunity in markets is endless. Capital is not. Every unnecessary trade is exposure. Every unnecessary exposure increases the probability of emotional decision-making, and emotional decision-making destroys timing. Good timing requires clarity. Clarity requires patience. Patience requires confidence, and confidence does not come from winning trades. It comes from disciplined behavior repeated over time. When a trader begins to respect timing, something interesting happens. Trading becomes quieter. There are fewer trades, fewer emotional spikes, fewer impulsive decisions, but the quality of execution improves dramatically. Instead of reacting to every candle, the trader begins to observe the structure of the market. Instead of chasing momentum, he begins to wait for confirmation. This shift is subtle, but powerful, because once timing improves, mistakes decrease. And when mistakes decrease, consistency appears. Consistency is the foundation of profitability. Without it, trading becomes unpredictable. With it, trading becomes controlled. That control allows a trader to think clearly even during difficult market conditions. It allows him to sit through a valid setup without interference. It allows him to accept losses without panic. And it allows him to stay patient when nothing is happening. These are the traits that define long-term traders, not prediction, not speed. If there is one lesson that separates profitable traders from struggling traders, it is this: the market does not reward intelligence. It rewards discipline in execution. Many traders are incredibly smart. They understand technical analysis, market structure, macroeconomic events, and risk management theory. They read books, study charts, watch countless videos, and absorb enormous amounts of information. Yet they still lose money. Why? Because knowledge does not guarantee timing, and timing cannot be learned through information alone. Timing is developed through experience and emotional control. The trader must learn to recognize when his decisions are being influenced by impatience, fear, or excitement. These emotions appear quietly, and if they are not recognized, they distort execution. The majority of traders operate in a constant cycle. They enter trades too early because they are eager. They enter trades too late because they are afraid of missing out. They exit trades early because they fear losing profit. They hold losing trades because they hope the market will reverse. This pattern repeats endlessly, and the trader begins to believe the market is unfair. But the market is not unfair. The market is simply revealing the trader's timing errors. Once a trader begins to see this clearly, everything changes. Instead of searching endlessly for new strategies, he begins refining his execution. Instead of focusing only on analysis, he focuses on discipline. Instead of reacting emotionally to every movement, he begins observing patiently. This shift transforms trading, because timing improves when the trader slows down. Slowing down allows the trader to think. Thinking allows the trader to evaluate conditions objectively. Objective evaluation produces better decisions, and better decisions repeated over time create consistent results. This is why the best traders often appear calm and unemotional. Not because they lack passion. It is because they understand the cost of emotional timing. They have experienced what happens when impatience controls decisions. They have seen how a single impulsive trade can damage days or weeks of disciplined work. So they become selective. They wait. They observe. They allow the market to reveal its structure before acting. When the moment is right, they execute with confidence. When the moment is unclear, they do nothing. That restraint protects their capital, and protecting capital is the foundation of long-term success. Most traders are focused on making money. Professional traders are focused on avoiding mistakes. Because when mistakes are minimized, profits naturally follow. Timing is not about predicting the exact top or bottom of a move. Timing is about entering when probability is favorable and exiting when conditions change. It is about acting only when the market offers clear opportunity and remaining patient the rest of the time. The difference between losing traders and profitable traders is rarely the strategy they use. It is the moment they choose to act. Master that moment, and trading begins to change. Ignore it, and the market will continue teaching the same painful lesson. Your timing matters, and until it improves, profits will always remain out of reach. But once timing becomes disciplined, controlled, and consistent, the market begins to feel very different. Because now you are not reacting to the market. You are working with it. And that is where real profitability begins. Timing. It rewards discipline in timing those ideas. There is one more truth about timing that most traders only realize after years in the market. Timing is not just about when you enter a trade. It is about when you choose to participate in the market at all. Many traders believe the market must always offer opportunity. They believe that if they study hard enough, analyze enough charts, or monitor enough indicators, they will always find a trade worth taking. But the reality is very different. Markets move through phases. There are moments of clarity when structure is clean and probability is visible. During those moments, timing becomes easier because the market itself is cooperating. But there are also long periods where conditions are unclear. Price moves sideways, momentum fades. Signals appear and disappear quickly. The market becomes noisy and unpredictable. This is where the majority of traders make their biggest mistake. They continue trading. Instead of recognizing that the environment is poor for their strategy, they assume the problem is their analysis. They begin forcing trades, adjusting indicators, and increasing activity in an attempt to find opportunity. But activity does not create opportunity. In fact, excessive activity often destroys it. Professional traders understand something very important. Sometimes the best timing decision is not entering a trade. It is stepping away entirely. There are days when the market is simply not aligned with your edge. There are weeks when volatility is inconsistent. There are periods where the market is dominated by uncertainty. During these times, forcing trades is the fastest way to damage your account. The disciplined trader recognizes these environments quickly. He reduces his activity. He protects his capital. He observes rather than participates. This patience often feels uncomfortable at first, because most traders are conditioned to believe that success comes from constant effort. But trading is not like most professions. In many careers, more effort produces more results. In trading, more activity can produce worse results. The market rewards selectivity, and selectivity requires restraint. The best traders in the world do not trade eve, rye day. They wait for favorable conditions. They wait for the moments when market structure, momentum, and risk alignment create a clear opportunity. When those moments appear, they act decisively. When they do not appear, they wait. This ability to wait without frustration is one of the most powerful advantages a trader can develop. Because it prevents unnecessary losses, it protects mental clarity, and it preserves confidence. Confidence is another important factor in timing. When traders experience repeated losses, their confidence begins to deteriorate. Once confidence declines, decision-making becomes distorted. Traders hesitate on valid setups or enter trades with uncertainty. This hesitation affects timing. Trades that should have been entered confidently become delayed. By the time the trader finally acts, the move is already underway. Once again, the result is poor timing. The solution is not more analysis. The solution is emotional stability. Stable traders maintain confidence because they understand the probabilistic nature of markets. They accept that losses are inevitable, and they do not interpret them as personal failure. Because of this, they remain calm. Calm traders make better timing decisions. They enter when the setup appears. They exit when the structure changes. They avoid chasing price, and they avoid forcing trades. Over time, this calm approach produces a very different experience in the market. Trading becomes less stressful. The emotional swings become smaller. The decisions become clearer. And most importantly, the trader begins to trust his process. That trust allows him to execute without hesitation. Execution without hesitation is the final stage of good timing. At that point, the trader is no longer reacting emotionally to market movement. Instead, he is following a structured plan built through experience and discipline. He understands that every trade is only one event in a long series of outcomes. He does not need every trade to succeed. He only needs to execute correctly. When execution is correct and timing is disciplined, the results begin to align naturally. Losses become smaller, profits become more structured, and the equity curve begins to stabilize. This is the transformation most traders are searching for. But it does not come from new strategies. It comes from mastering the moment of action. Because trading is not just about what you do. It is about when you do it. And once you learn to control that moment, the market stops feeling chaotic. It begins to feel understandable, not predictable, but manageable. And in trading, the ability to manage uncertainty with discipline is what ultimately separates consistent traders from those who struggle. Timing is not just a technical skill. It is a reflection of patience, discipline, and emotional control. Master those qualities and timing improves naturally. Ignore them, and no strategy will ever be enough. Because in the end, every trade comes down to a simple question. Are you acting at the right moment, or are you simply reacting to the market? The answer to that question determines everything.